everybody. Welcome to the Trading with Ashley show. It's just so beautiful outside. I decided I would just come enjoy nature and talk to you about stocks. What could be better, right? So I wanted to let you know something that is around the corner with covered calls. I'm seeing it in my Discord. I'm personally experiencing it. We are getting into the dynamics with the market where you're probably going to start seeing some green if you bought the dip like I did. And you're going to want to take advantage of that and sell covered calls. Well, I have a great video I did on the best time to sell covered calls. So I'm going to leave that at the end. But as you start seeing some green in your portfolio and you want to do the wheel strategy, you might take advantage and start selling covered calls only to find out that it's blown through your covered call strike. And if you're going to sell covered calls, I would not go out more than 1 week at this point, because one good little bit of news about these tariffs could send the market skyrocketing. Now, the statistics show that there's 10 significant trading days in the market, and most of them come on the heels of the stock market going down like we just saw at that 10% mark. Now, I don't know if we are going to go up from here. The market oscillates up and down. We did just recapture the 200-day moving average on the SPY, but it's known to be tested as well. So we could go up only to retreat and retest the 200-day moving average. And if we move below the 200-day moving average, well, then we have further down to go. So just be prepared for that and don't throw all of your money in the market right now if you're starting to see some signs of green and bullish. But I wanted to talk to you about a specific trade, and this is Tesla. So I believe in Tesla. I believe in the stock, and I think that the future of the stock has so much potential. And I'm not talking about car deliveries because I know that those have been down. I am talking about what is going to be bringing revenue to Tesla in the coming years. Particularly, they are going to do the unsupervised driving. So that's software that I think will be wildly popular. And they are putting that into the robo-taxis that they are going to be unleashing this summer. You couple that with the robots and everything that the potential robots can do, from factories to households. I think it has a very strong trajectory on where it's going to go. So I want exposure to that because I believe it's disruptive technology like what Tesla is offering is what will take my portfolio to the next level. So I'm very bullish on Tesla in the long term. And I saw this recent pull down due to all of the dynamics going on with Elon and with Doge. I saw it as a buy-in opportunity. So I did buy some additional shares of Tesla. Well, at the first sign of some green, I saw an opportunity to get a little bit of extra revenue and sell covered calls. So on Monday, I took my shares that I had acquired right at around that $230 mark, and I sold the 285 covered call on Tesla. It looked like it was pretty far away. It was below a 0.2 delta, but only to wake up Tuesday and to see that there's still a lot of buying pressure on Tesla. In fact, I looked at the volume bars this morning and I said, this is not going to slow up. So I decided to buy back the call that I had sold. Now, let me share with you what I did to actually get on top of it and actually make money out of this situation. And this is the flexibility of options. Once you understand how to use options to your benefit, you can do similar dynamics to help yourself get out of a situation because you have a lot of opportunities to adjust your trade. So let's take my specific trade. So my specific trade on Monday, I sold the 285 strike on Tesla. I am saying you can take my shares at 285 if we breach that strike price. Well, again, like I said, I saw that it was pushing towards 285. So what I did, I bought it back. And so I bought it back. It cost me $5.37. So that left me with a deficit at this point of $3.48 a share. So I got to thinking, I said, if I didn't want my shares to get called away, it's obviously because I do believe in the stock longer term. So what I decided to do was go ahead and sell a $270 put, meaning I was putting up $27,000 less if you're using margin, agreeing to buy Tesla shares if by the end of the week that they were 270 or below. And for doing that, I was paid a premium. Now, keep in mind, at this point, I'm losing $3.48 a share on the repurchased call. So when I sold this $270 put, I received $6.68 to sell that put. So getting that additional premium actually helped put me back on top for the trade. So now I am seeing $3.20 to the positive. So if by Friday, Tesla's price action at close of day is above 270, then I'll get to keep 100% of that premium and it will release my funds for other trades. But if I'm put the shares, I'm okay with that because I have a strong belief in the future of the company as well. And so you have to be okay accepting the shares. That's key to the will strategy. And as my students are seeing, we had been put shares on some of our plays, and now we are getting to start to enjoy selling covered calls against those plays. Some aren't ready, just like when you're baking a cake and you're really wanting that cake, you just have to let it bake a little bit longer in the oven. We're letting some of our plays bake a little bit longer because when you're doing the will strategy, you're going to make the most money on the stock appreciation. The premiums are nice. It's an extra little boost. It's a bonus. But the most money you're going to make on the will strategy is when your shares are called away in profit. So I want you to remember that. For one, I don't want you to be afraid of being put the shares if it's a quality company, if they have great fundamentals, and you believe in the future of the company, coupled with it's at a good point in its price life cycle. I've got plenty of videos that showed you where the best point is to be assigned shares. If that's the case, you're put the shares, just sit tight for a little while, then look to sell your covered calls and be okay with the call away. Now, I was not okay with the call away in this situation because the volume was so strong and I do see additional upside and I'm patient, so I'm willing to wait. So I'm going to sit tight for a little while before I sell new covered calls on Tesla. I'm going to let it continue to run. But in the scenario I showed you, I was able to actually make more money as long as it expires worthless. So that's a way that you can claw back some lost premium from buying back calls that you probably shouldn't have gotten in to begin with. Now, one thing that I was telling one of my students today on one of our calls, you might want to make this easy on yourself. Let's say you buy back a call and you want to keep up with how long it's going to take you to make that money back. Well, first of all, rolling the call might not be the best situation. So I want you to think about that. It's called the delayed roll. Buy back the call, then let Tesla, if that's the stock, continue to rise to compensate you for the amount that you're losing. So in my scenario, had I not sold another put, because I've already been made whole at this point as long as it expires worthless, then what I would have done is I would have put a big negative $3.48 a share on a notebook. Then when Tesla rose another $3.48 a share, now I'm at the point where I could start considering selling covered calls again because my account had been made whole. So that's one way to get at it where you don't find yourself in this constant rolling loop. Buy back the call if you have strong volume that is showing it's going to keep running, and then just sit and wait and let the stock's movement up compensate you for the fact that you had to buy back the call. Hope you found that helpful. Remember, if you're with me, Trading with Ashley, there is no trader left behind.